This is Tom Aspray with the Viper Report Market Wrap video for the week ending August 2nd. Well, if you're watching the stock market at the end of last week, some of you may have thought somebody rang a bell that the recession had started. Since I've been on a recession watch since I changed careers from a biochemist in the early 80s, my seasoned view is that this is very unlikely to be the start of a recession. So what was all the hoopla about? You may have heard that the stock market is determined by fear and greed, so this was the fear component. We'll look at the charts here in a second, but basically my view is that this is more like a panic sell-off that probably won't last long. It could still go lower, of course, but will probably be likely be followed by even higher prices before the end of the year. So the SAM rule, SAHM, Claudia Sam, economists predicted every recession since the 1970s, basically is tied to an increase in the jobless rate, which exceeds her parameters, as discussed in this article. So she also has commented, as have many other economists, that a recession is not imminent, even though the SAM rule is close to triggering. Her view, the swing from labor shortages caused by the pandemic to a burst in immigration is magnifying the increase in the employment rate. You've been watching the market for a number of years. You might remember in April of 22, the yield curve inverted, as this arrow indicates. Search back, headlines, for stock market comments in April of 22. You see, this means a recession is inevitable, as a commentary. Has to be a recession. It's always worked, etc., etc. And obviously, stock market has been pretty strong since then, and it's still signaling this. So it could be right, where you can't go on forever without a recession, but now does not appear to the time by everything I look at. And this is a monthly chart. Of course, we're down this month, but we'll save this till the end of August before we discuss it. Basically, this is the S&P AD line, positive, making a new high. Stocks only, NYSE also made a new high, and as did the NYSE all AD line. So all these monthly indicators are positive. Now, if you want to find that article on the SAM, if you Google USA Today :SAM, SAHM, you'll get the article right here, and you can read it at your leisure. So let's look at the markets here. NYSE Composite looked like it broken out on a weekly basis a week ago, surged to a new high, and then reversed to the downside, right back to the 20-week EMA. Those of you who followed my stuff for years, and when it's rising, that often is an area of support, as it was, in June and as it was in April. So the stocks on the AD line still positive, still above its moving average, which is right in here, and recently made a new high. So big, recessions and bear markets are generally are accompanied by the AD lines diverging from the market. So new high in the AD line, new high in the averages. So no divergences here. With technical analysis, the nice thing is you can, have some clearly defined levels if you're wrong, and you can see these support levels. If this were to start breaking below its moving average and start a new downtrend, that would be a more negative sign. All the recessions I've watched, if you look at 2007, 2008, look what Jamie Dimon or some of the folks on CNBC, like Larry Kudlow, were saying about the economy. No housing problems, etc. So we know how well that worked. We talked about last time the fear gauge is rocketed to the upside. This is the highest it's been for a long period of time, and at this point it shows no signs of peaking, other than the fact that some people look like if this drops 4%, from 23, on Monday or Tuesday, that will be a short-term buy signal. But still, it's in a positive trend at this point. Option players got a little more involved towards the end of the week. You can see the CBOE total put call, 16% more puts than calls. The index 30% and got up to 40. You can see early in the last decline into April, it was even higher. there was definitely some pretty severe price damage. You can see the big reversal on Thursday, the down gap. The S&P got right back into the highs from May, and the next likely target is the late April, late March, early April high, down about 523. Interestingly, that also corresponds to up here, if you can read the tiny print, the monthly S1, which is 523.43. No signs of a top on the S&P 500 AD line, still above its moving average and still positive. Same for the NYSE all AD line. They're both, suggesting this is just a sell-off and likely a buying opportunity. Of course, the selling was the worst in the tech due to their earnings were, either in the Viper report or the hot stocks report. We had very few tech holdings because most of them were stopped out when XLK and etc. was showing some signs of weakness up here. We have lower highs in the AD line. So it's back to negative. Key support level are here and then down in here, and basically to turn this around, first sign would be a move above this peak. RS is plunging. It's obvious the Q is much weaker than the S&P. Looking at the selling pressure, it was moderately heavy in the Qs. It was down over 60% on Thursday and about 50% on Friday. Same for the small caps, the S&P 1500, less than the S&P. A sign of the heavy selling was evident in the new high, new low analysis. You can see 116, I think, with the level we've been talking about for a while. There was 116 new lows on Friday. So it could break out above that easily early in the week. Is that a stronger sell signal like we saw in the summer, of 23? Too early to tell yet. Right in here, when that occurred, the AD lines were already negative, and they're not now. NASDAQ looks a little worse. It's up to 334, just below its prior peak. And of course, we have, lower highs and the number of new highs. Small caps, they finally pulled the plug on it. You can see this down gap in the IJR. So our new buy levels in the IWM were hit, actually in Qs as well. So, but we managed our stops, so our stops are keeping us in at this point, and time will tell. You can see that, normally, when you see a breakout of a range that lists that long, you would expect to see a much stronger move than we've seen. So this looks like to be just some panic liquidation here. We get back above the 20-day EMA on IJR at 113.62. That was sort of stop the bleeding. The volume was extremely heavy, so that's on the negative side. The growth value, still declining, favoring value right now. MACDs have turned negative. But you can see we're kind of coming into this uptrend line B and some support. So that would suggest, it would increase the odds of a growth rally in the next couple of weeks. If you look at the weekly chart of the Qs, you can see we're down below the 20-week EMA and getting close down 433 roughly as a Stark band, and we closed at 448. So new highs in the NASDAQ 100 AD line. So that does not mean that this is a major top. You were getting back into, as we said, the highs from earlier in the year, and the longer term uptrend is around 420. The longer term relative performance is back to key support here. So at this point in time, the Qs are still not leading the SPY. So, but if this were to turn around, we'd look for it to get back above its moving average to see that we had a new leader. This has done us very well over the years. Early 23, nobody was expecting growth to win. We were based on this and that growth value analysis, and pretty much have skewed in terms of growth until a couple months ago. We discussed the 60-minute charts in the Viper report on a regular basis, and I'll be updating this tomorrow. But I thought it'd be interesting to see that, look at this as an hourly chart that goes back to April. So, this was a prior high at 531. We broke out above that, had a tremendous rally, and now we're right back to that level. So next support here around 522 down to 516. So, that's also favors. And if you look at the OBV, it's acting, it's back to where it was right around in here, and it's holding up quite well, suggesting that, the selling has really not been as severe as many would have thought. Look next at some of the details from the ETF weekly scan report, just to show you what happened. So XLY, XLE, SPY all gave new weekly sell signals. The QQQ had already been negative, as had SMH, which was down, I think, 7%. XLC, XLK were all weekly negative. Okay? So the only ones that are positive right now are staples, healthcare, materials, XLRE, that's like the REITs, and the utilities. Some of these have 3-day DTSs, but over here you can see that, on a 1-hour basis, the XLP, XLV, and XLU had some late buying on Friday, suggesting that some people were bargain hunting. Obviously, lots of changes in the T&J watch list this week. You can see that now only 46% are above their quarterly pivot, so that's a negative reading. Growth got really hit, 20% positive. You can see, ITB and XLV are the few of the ones that are holding up. And I am pretty positive on the home builders longer term. Obviously, the sharply lower rates, bonds really plunged last week. Mortgage rates are going to be coming down, so that's going to be good for both people who are wanting to sell their homes as well as buy a home. Value gauge is still acting better, 63% positive down here, and 63% have weekly DTS signals. You can see only 20% of growth does. So, XLC was picked up a little bit on Friday after being hit, but only 9% of the value stocks have a positive daily momentum. All right. If you look at the shorts, they're still pretty strong. The Dow daily negative, DTS, that's SDS, that's an S&P short, that's a leveraged short. Conversely, most of the long ETFs, as we mentioned before, are negative. In fact, if you look at this chart from TOS, the DTS signals, SPXS, the short one, turned positive right around here. It had a pretty nice move up. It's back to the Stark band, and it got resistance not too far above current levels. Lots of changes in the sectors. Most dramatically was the fact that both the conservative XLU, utilities, and the real estate stayed strong. You can see a little red in the real estate gauge, and there were a couple of REITs that turned up in the buy list this week, but they're still all green across the board. Probably getting it a little extended here, and you can see PSA was one that had a new daily DTS as of Friday's close, and as did DLR. So on the downside, tech, no surprise, 8.3% are positive based on the 3-day. 50% are still weekly positive. So, Apple, we put an order in to buy Apple on that drop, and it's actually think its correction may be over. You may have read a thing in Forbes at the end of May about it. It triggered a weekly doji buy signal, so I'm still optimistic on it. Financials were hit harder than I expected. You can see AXP was hit, stopping our longs out. So 36.4, that was a big change from the prior week. Some XLY was still the same at 58%. Healthcare, improved. No, healthcare was unchanged. And consumer discretionary actually rose a little bit. Industrials and materials all dropped down. They were 75% last week, now 50%, now 41%. Energy was hit hard. only 25%. VLO is one of the few stocks in there, but not a lot of course, the crude was got hit pretty good as well last week. From the themes report, you can see also the oil and gas gauge, pretty sagging, 30% weekly DTS, 20% 3-day, and only 20% above their quarterly pivot. ExxonMobil, and of course the big carnage in the Qs, 0% above are positive based on all the 3-day DTSs are negative, 25% weekly DTS, including Apple and Tesla. Meta started picking up a little bit. You can see, so it could be the first one to turn. You can see that it did close back above its quarterly pivot on Friday, so that was definitely beating the trade. Meta, we'll be looking for a 3 DTS positive signal early in the week, to add further weight that its correction is over. So Dow sort of a mixed bag, 50% right in the middle. So the bottom line here is this is not a reason I think to panic. If you got stopped out of some longs, that's what stops are for. So the dust should settle early in the week. To support the positive case, we'd like to see a really good rally and a strong close next week. On the negative side, if we see a sort of a couple of day, 1%, 1.5% rally, and then that's followed by another push to the downside, that would indicate that the correction is still intact, and that might cause some more negative signals in the daily AD lines. So stay tuned. Recent reports are on the viperreport.com if you'd like to sign up. Thank you very much.